The next section we're covering is how to account for notes receivable. We can start with the definition of notes receivable. At the top, we see that notes receivable are amounts due from others that A, are expected to be collected in cash, and B, are evidenced by a written promise to pay. And this is also called a promissory note. Now, if we look at the bottom, we can recall from the earlier lecture that accounts receivable are amounts due from customers that A, are expected to be collected in cash, and B, have resulted from the sale of goods or services. So immediately we see that notes receivable are a little bit different. For starters, we see that the amounts that are due don't have to be from customers, although they can be. Also, we see a commonality that both notes receivable and accounts receivable are amounts due that are expected to be collected in cash. Now, also with accounts receivable, we see that these amounts due have definitely resulted from the sale of goods or services, whereas with notes receivable, we don't see that in the definition. So with notes receivable, it doesn't have to be resulting from a sale. Another thing about notes receivable that is unique and distinct from accounts receivable is that with notes receivable, there is a written promise to pay, also called a promissory note. So these are some differences, but the main similarity is that both notes receivable and accounts receivable are expected to be collected in cash. That's the main similarity. And also with notes receivable, we can see that they typically originate from either lending money to someone or an entity, or providing goods and services, just like with accounts receivable, or we could get a note receivable from accepting a promissory note as payment for an account receivable. Now what we have here is simply journal entries for each of the ways that we can receive a note receivable. At the top, we see that we have lent money to someone or some entity, so we debited notes receivable and we credited cash. Secondly, what we did is made a sale, and in exchange for that sale, we received a note receivable instead of an account receivable. And so we debited notes receivable again, but this time we credited sales. At the bottom, we see that we received a note receivable as payment for an account receivable. So we debited notes receivable again, but this time we credited accounts receivable, meaning we removed that amount from the accounts receivable balance. Now, because the entity or the customer that owes us money via this note receivable is going to have to pay us interest on top of the principal of the note receivable, we have to know how to account for that interest, which is interest revenue to us, and for the entity or the customer that we're dealing with, it would be interest expense to them. So at the top, we see our overall formula for the amount of interest, and that is simply principal times rate times time. So it's easiest to see this by example. In this example, we have $1,000 of principal, and that's the amount loaned originally. We have a 10% interest rate, and we'll notice that this is an annual rate, and it is, of course, specified by the note. And the term is 1 year. This is the length of time from origination to maturity. Maturity is a fancy word for due date of this note receivable. And this note originated April 1st of 2013. And so, of course, its due date is a year later, March 31st, 2014. So at the bottom box, we see that all we had to do was take the principal of $1,000, multiply that by the rate of 10%, which is an annual rate, and we multiplied that by the time factor. In this case, as of December 31st, 2013, only 9 months had expired. Well, we couldn't multiply the 1,000 by the full 10% because that was an annual or a 12-month rate. What we had to do is take 9/12 of the rate, so 0.75. We multiply that by the rate, And in the end, we get to the interest amount of $75 at the bottom. And here we very simply see the interest revenue recorded that we just calculated in the previous slide. All we have to do is debit interest receivable for the 75, and then we credit interest revenue also for the 75.